Welcome to the Econista. I'm so glad you're here. In my last video, I talked all about inflation, what it is, and why we've been seeing so much of it recently. And I mentioned that the president actually doesn't have as much opportunity to impact inflation as one might think. A lot of the control of this and response to inflation happens from the Federal Reserve or the Fed. You may have heard of the Fed, but you don't really know what they do. Maybe you heard some of the recent headlines around Jerome Powell. In this video, I'm going to break down who they are, what they're responsible for, why they are separate from political pressure, and why it has been designed that way. And then lastly, break down some of the recent events going on with the chair of the Federal Reserve. So let's start with the history. Up until 1913, the US didn't have a central bank. In the 1800s, there would be runs on banks and panics, and they would just unfold. The US government didn't really get involved. Then there was a pretty significant financial crisis in 1907, and JP Morgan actually had to get involved to figure out bailouts and keep the banking system afloat. Congress took notice of this and realized we have to do something. We have to set up some kind of central bank to oversee the economy, really. And so in 1913, Woodrow Wilson signed into law the Federal Reserve Act, which created the Federal Reserve we have today. So what actually is the Federal Reserve? Well, there's a couple of different components which make it actually pretty complicated to understand. So first, there are 12 regional banks throughout the US that are Federal Reserve banks. Each of those has their own president. Additionally, in Washington, D.C., there is a board of governors made up of 7 members, including a chair. And then there's the Federal Open Market Committee, or FOMC. A lot of times you'll see them in the news when a decision has been reached on interest rates. And that body is made up of 12 members. It consists of all of the board of governors, as well as some of the presidents of the regional banks. And important to note that the board of governors are appointed for 14-year terms, and they are staggered, so every 2 years, one of the governors will be up to be replaced. And then there is a chair who is appointed for 4-year terms. And so the board of governors and the chair are nominated by the president and confirmed by the Senate. It's a very deliberate process to not give one person too much influence over the board of governors because they are really designed to be separate from political pressure. So what does the Fed actually do? Well, the core of their responsibilities is what's called a dual mandate. So there's 2 key things they're focused on. The first is inflation. So they have a target inflation rate of 2% per year, which really allows the economy to keep growing without letting inflation get too out of hand. In addition, they are responsible for maximum employment. And so when you hear maximum employment, you might think, oh, so everyone's employed. But actually, that is not the case. So there's something called the natural rate of unemployment, and that basically means that at any given time, maybe some people are between jobs looking for another job, or they just don't have the skills that match with the jobs currently available. So the Fed actually does projections of this. It will change slightly depending on the projection, but usually that's between 4 and 5%. And the interesting thing about the dual mandate is it's very hard to balance both of these. They're sort of counterweights, and I'll explain why when I go through the federal funds rate and how they really impact the economy. A lot of times you'll hear that the Fed is increasing interest rates or decreasing the interest rate, and it maybe sounds like they have control over a whole range of interest rates. But actually there's one specific interest rate that they set, and that is called the federal funds rate. The interest rate that banks charge each other for overnight loans. And basically the way that it works is that when that rate goes up, the interest rates that banks charge on their other loans have to go up. And so it kind of ripples through the economy. Now, when the Fed is changing interest rates, that can impact both inflation and unemployment. So for example, when there's a period of high inflation, basically there's a lot of money in the economy chasing after too few goods, they are going to increase interest rates. Now, when they increase interest rates, that means it's going to cost you more to get a mortgage, to get a car loan. A business loan is going to cost more. And so people naturally look at the new rates and they say, maybe I'm not going to buy a house right now. Maybe I'm not going to take out that business loan right now. A lot of people are doing that today, right? Because the interest rates have been pretty high on mortgages. That means that it slows down the economy. It slows down businesses growing and investing. The downside of that is that can actually lead to unemployment. So as fewer people are taking out these loans, as fewer businesses are really expanding, they might decide that they don't need to hire more workers, or they're going to let go some of their existing workers. And so when the Fed increases interest rates, that puts us at risk of increased unemployment. The opposite is also true. So when the Fed decreases interest rates, that's really a way for them to get people to spend more money. So for example, in the Great Recession, they really cut interest rates to try to get more money flowing through the economy, try to address the unemployment rate. And as more businesses take out loans, people take out loans, there should be more economic activity leading to an increase in jobs. So that's sort of how it works. The con of that would be the opposite of what we talked about with increasing interest rates, which is if you have really low interest rates and people are taking out all this money, you risk overheating the economy and leading to inflation. And so those are the two kind of counterbalancing points they're trying to balance at all times, using the interest rates as really their core lever. I mentioned earlier, the Federal Reserve is really designed to be independent of political pressure. And the reason for that is that presidents may not always want to do the difficult things it takes to manage the economy. So I'll give you two examples, one of a president who exerted political pressure and then a counter example. So the first example is President Richard Nixon and his Fed chair, Arthur Burns. Nixon put tremendous pressure on Arthur Burns. We actually know this because of the Nixon tapes. In addition, we have Burns' own diary where he writes about the stress this put on him. But Nixon really did not want Burns to increase interest rates and slow down the economy, even though they were starting to see some inflationary pressure. And so he repeatedly tries to get Burns to decrease the rate, and Burns complies. Now, in his diary, you can really see how torn up he is about this. Nixon's threatening to add governors to the board of governors to basically have him lose control of his board. And there's a lot of pressure put on him, so I don't want to make him seem like the bad guy, but he does ultimately comply. Nixon wins re-election in a landslide, but these actions of keeping the interest rate low eventually lead to inflation getting absolutely out of control. Inflation actually peaks at 14.6% in 1980 under Jimmy Carter. And in part, that's due to the Fed not taking actions to increase the interest rates at the time. And the counterexample to this really is Jimmy Carter. So Jimmy Carter inherits this mess, inflation rates are out of control, he has to pick the next chairman of the Fed. And he selects Paul Volcker, who is really outspoken about the fact that he thinks the Fed needs to get inflation under control, and he is willing to increase rates to do so. Even though that's the case, and honestly, it's not going to be very popular to increase interest rates, Jimmy Carter appoints Paul Volcker anyway, because he wants whatever to be done that needs to be done to really handle the economy. Volcker raises interest rates and raises them. Interest rates actually peak at 19%, and this has horrible impacts on employment. So between 1981 and 1982, 4.1 million jobs are lost. The unemployment rate peaks at 10.8%. For context, that's even higher than the peak of the Great Recession at 10%. But Paul Volcker is able to bring down inflation from 14.6% in 1980 to under 5% in 1982. So it really does work, and a lot of economists credit him for the period of relatively low inflation after this because he did what needed to be done. However, Carter really suffered politically, Not only because of this, but he does lose re-election. So what you have there is a president who pressured the Fed chair. That ended up terribly for the economy, but it helped him politically. And a president who allowed the Fed chair to really aggressively go after inflation and suffered politically. That brings us to today, where there's actually a lot happening between the Federal Reserve chair and the president. So President Trump has really gone after Jerome Powell publicly. He's called him everything from a dummy to a numbskull to a moron. He's also had his Department of Justice open an investigation into Jerome Powell and his apparent mishandling of the renovations of the Federal Reserve headquarters. This was ultimately dropped because there wasn't actually a lot there to support this. It's kind of ironic that Trump is going after Jerome Powell so publicly and aggressively because wanna guess who appointed Jerome Powell to chair of the Federal Reserve the first time? It's Trump. So really an odd situation, but basically he's going after Powell because Powell is refusing to lower the interest rates, which as we know are really critical to ward off inflation, and Powell doesn't think it's warranted to lower the interest rates at this point. And so Powell has really held firm in the midst of all these attacks. That being said, he did have to step down in that his term ended, and so Trump was able to appoint a new Fed chair, Kevin Warsh. The Senate confirmed him, and he took office on May 22nd of 2026. However, what's really interesting is what Jerome Powell does in response. So typically, if you were the Fed chair, you would just step down and retire. But technically, you do still have your 14-year term as a board of governor. So you could go back to that seat. It's just that no one has actually done that since 1948. However, Jerome Powell has now come out publicly and said he did plan to retire, but given the legal attacks that the Federal Reserve has faced, he has decided to resume his seat on the Board of Governors, which will run through 2028. So this is basically denying Trump the opportunity to replace him with another appointee until his term is over. And he's said that the legal attacks that the Federal Reserve has faced have been unprecedented in the institution's 113-year history. So that's where it stands today. We've also recently had the first meeting under the new chair, Kevin Warsh. June 17th, Kevin Warsh had his first meeting as the Fed chair, and the results are pretty interesting. So Trump nominated Warsh really in the hope that he would bring interest rates down. As of the first meeting, Kevin Warsh did not comply with this. He held interest rates firm for the fourth consecutive meeting in a row. Additionally, the committee's estimates of future rates changed pretty meaningfully. So after this meeting, they had projected that they expect about 0.25% increase in rates. 3 months ago, the average committee member said they expected rates to be cut by 0.25%. So a pretty significant change there, but Warsh did a few things very differently from how they've been done in the past. Notably, he did not submit an estimate on the future interest rates. He also majorly cut down the statement he made after the meeting. So it was cut from 341 words, the last statement made, to 132 words. And most notably, he removed the forward guidance, which is sort of an estimate that the Fed chair will give of where they think things are going to go in the future. And he said it's not really helpful and it sort of locks in the Fed. So he wants to remove that. It's really very short on his words, described as curt and very matter of fact. A few days after the meeting, then, he announced 5 task forces to basically dig into how the Federal Reserve works, the data they use, how they set policy, and go over basically everything they actually do and look at ways to change things. So he is really signaling that he is going to bring a lot of change to the Federal Reserve. We don't really know what that's going to look like or what the results of these task forces are going to be, but I'm definitely keeping an eye out to see how things unfold. But as things stand today, Trump wanted interest rates brought down by the Federal Reserve, and he hasn't got that. We'll see where they develop from here. So now I've walked you through what inflation is, why it got so high during the pandemic, who's to blame for that, and who actually controls interest rates in response. But that doesn't answer other affordability questions like, why was housing so expensive even before COVID? Why do healthcare costs keep going up? Those are the kinds of questions I'm going to dig into in the rest of the affordability series. My next video is going to be all about housing and why it has gotten so unaffordable for everyday Americans and why it's so difficult to fix. I'm Teresa and I studied economics so you don't have to.